Voters and consumers have lived through the 40 most benign economic years in the history of mankind, between 1982 and 2022. They think that 6.5% deterioration in the value of their savings is an interesting academic anomaly. It's not. It's a threat to your listeners' well-being. And as that threat manifests itself over 2 or 3 years, the confidence born of 40 years of benign economic climate will be swept away, much like it was swept away in the later part of the decade of the 60s and the early part of the decade of the 70s.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Welcome back to Liberty and Finance. We have a fantastically popular returning guest, Rick Rule, the former CEO of Sprott Asset Management, now the CEO of Rule Investment Media, joins us this Thursday, April 7th, 2022. Rick, thank you for coming back on Liberty and Finance.
Always a pleasure, Donegan. I enjoy talking to your audience through you.
The only challenging part of our interviews that I keep struggling with is how to get 150 viewers submitted questions condensed down into something that we can tackle responsibly and comfortably within a short interview. We'll do our best. I'll try to summarize these into themes, I think. One of which is the unavoidable theme. I would call it the elephant in the room, but maybe it's the Russian bear in the room. And that's the people asking about the context and the meaning and the impact to investors, in addition to everything else we're thinking about as human beings, about the Russian-Ukraine situation and the European and U.S. and Chinese and all the other entanglements and cross connections that are related to that. Specifically, as you are seeing the investment scenario that you have taken personal steps in and talked to others about, the opportunities that are available in Russian mining companies, et cetera, in that jurisdiction, what are the main either concerns or encouraging signs that you're seeing through this time of troubles?
That topic could last us the whole interview.
It sure could.
I'll do my best to condense the response. The first thing is that I'm going to leave the moral consideration aside, and I'm going to let investors make their own moral decision. Certainly, the imposition of Russian will on the Ukraine is something that gives me moral concern, just as I've been concerned when our own government tried to constrain places like Afghanistan, Syria, Libya, and Iraq. By the way, I'm not drawing equivalencies. What I'm trying to say is that people are going to have to apply their own morality standards to investing in conflict zones.
Well, I would say beyond that, I want to give you more credit than that, because you have been a consistent and persistent voice through as long as we've known each other about your vehement objections to government intrusion in people's lives in every jurisdiction around the world. And this is perhaps a more glaring example of that, but it's in that theme that you've objected to all along.
Thank you. This is certainly government writ large. War seems to be the health of the state, sadly, irrespective of the state. But back to the investment theme. Russian stocks were the cheapest natural resource stocks in the world because there was political risk, because they were opaque, for a variety of reasons. The cheapest resource stocks in the world became as much as 80 or 90% cheaper several weeks ago. The risks around owning Russian stocks are obvious. First of all, you can no longer buy them or sell them on the London Stock Exchange. They've been at least temporarily delisted. And one has to buy them in Moscow, which is a challenge. If you are a U.S. person, you can't buy the stocks through U.S.-based brokerage firms or Canadian-based brokerage firms or British-based brokerage firms. You need to buy them from Dutch firms, firms in Liechtenstein, or for firms in Switzerland. And you run a risk as a consequence of the suspension of Russian privileges through the SWIFT banking system and Russian privileges in U.S. dollar denominated transactions. You run the risk of not receiving dividends or receiving dividends in rubles, which are unspendable. in the United States. Those are fairly obvious risks. A less obvious risk is that the longer the conflict goes on and the deeper the sanctions bite, the less able Russian companies will be able to transact. The less that they'll be able to buy consumables from the West, the less that they'll be able to sell commodities to the West. And so there is some risk beyond transactional risk, which is to say existential risk. There's also the risk, of course, that Mr. Putin will decide to reward his cohorts, the oligarchs, with increasing slices of the Russian economy at the expense of Western shareholders. Fairly ugly sense of risks. If those risks don't come to pass, you have the opportunity as a speculator to enjoy what could be tenfold gains, not in penny dreadfuls, but rather in the highest quality natural resource companies in the world. The idea that you could buy a company like Gazprom with reserves that are larger than Exxon's and enjoy, if things went right as opposed to wrong, a tenfold return in, say, 5 years with a very handsome dividend while you wait is an intriguing concept for somebody who can afford to lose all of the money that he or she puts up in that speculation. Both the risk and the reward are clearly in focus. If you were to compare Gazprom to Exxon, Exxon is an incomparably better company in the context of its international. It has strong refining and marketing presence, all that kind of thing. But on a net present value to enterprise value basis, Gazprom before the war was selling for about a third of the comparable multiples. And now it's on an 80% off sale. That's truly an astonishing bargain for those who are willing to deal with the moral dilemma internally and willing to stare 100% principal risk in the face. In the broader context, the Russian invasion of the Ukraine has at least two, probably three profound implications for natural resources. The first is the weaponization of the US dollar and the weaponization of the global financial system to service US interests against real or perceived foes. This will have the impact of lessening the US dollar franchise as the world's reserve currency. For 20 years, various societies around the world who felt nervous about transacting in US dollars because they were nervous about the extraterritorial reach of US policymakers now can stare into the breach and see what happens when the global financial system is run by the US State Department. Many people have stared into this breach and do not like what they see. This includes, obviously, Russia and China and India and Turkey and Iran and Saudi Arabia, a fairly formidable list of countries. I'm not saying that the US dollar won't continue in some way, shape, or form as the world's reserve currency, because we have the least opaque financial system in the world and we have the most liquid financial system in the world. While those countries don't trust us, they still trust us more than they trust each other. But increasingly, they have an incentive to find a way around the dollar. I think part of that way will be gold, because gold is fungible. It is a medium of exchange and simultaneously a store of value. I think that you will see limited two-way trade between various countries in their own host currencies, although I think that's less of a risk. But I think that what you will see over the next decade is a much more multilateral world with regards to currencies. And I think that that will be very difficult for the US dollar. The US dollar, I think, has suffered not a fatal, but a serious blow to its franchise as the world's reserve currency, which will, over the course of a decade, challenge the US government in terms of exporting its funding opportunities to citizens of other countries. The third circumstance that has been changed by the Russian invasion of the Ukraine is a tangible evidence of just how fragile worldwide commodity supply chains are. People have known for 15 or 20 years that eventually, for Malthusian reasons, we would see a return to the decade of the 1970s, where there was a global scramble by consuming countries of resource assets. But it was always a problem that was 5 years away or 10 years away. 5 years ago, as opposed to 15 years ago, we began to see inflation in the supply chains that would lead to the construction of new mines and new oil and gas fields. And we began to see constraints on global trade in commodities and global flows of capital. What we've seen now is a breakdown in global flows of capital. We have seen the impacts of sanctions and the weaponization of the currency. We have seen in the uranium market, as an example, just how fragile these supply chains are. Of course, we've seen it in the oil and gas markets too. But you have a circumstance where globalization is reversed and nationalization takes hold. And that happens in a world that isn't as balkanized in terms of its access to commodities as the leaders would hope. The ability, as an example, that the German people have to get through winter without Russian gas is nil. And hence, the German people, as an example, have come to understand that whether they like nuclear power or not, their choices become freeze or restart their nuclear plants. Similarly, despite their Kyoto protocols, what the Germans have learned this winter is, were it not for coal, they would have had an extraordinarily uncomfortable winter. What we've learned in the uranium business is, although we haven't sanctioned Russian uranium, or more importantly, Russian enrichment, the Russians are responsible for 40% of the world's uranium enrichment. And there's an awful lot of self-sanctioning going on, which is to say utilities that aren't required not to consume Russian fuel are, for moral or political reasons, reneging on Russian fuel contracts anyway. And the idea that reprocessed fuel is 18 to 20% of the total fuel requirements of the nuclear fleet around the world. If you take 40% of 20%, which is to say 8% of the nuclear fuel volume out of fuel markets that were already out of balance, you have a growing appreciation of the fragility of the supply chain internationally. The Russians produce about 40% of the world's platinum group metals, platinum and palladium. And while they aren't sanctioned, Western consumers don't have the ability to pay in dollars for platinum or palladium from Russia. This will impact catalytic converters for automobiles. Russia produces 7 or 8% of the world's nickel. They're the world's lowest cost nickel producer by a country mile. The Russians are the most important potash producers in the world. The Russians are the most important suppliers of natural gas and the second most important suppliers of crude oil to Europe. And the consequence of the drama that we've seen in Russia has reinforced, both strategically to governments but also to investors, the importance of access to diversified supply worldwide. And I think it's changed the value of legacy deposits, high quality legacy deposits around the world. If you're Japanese, you don't want to be solely reliant on Saudi suppliers or US suppliers or Russian suppliers. Everybody has learned that despite the fact that we're moving in a balkanized fashion to resource nationalism, that the global economy is much more interconnected, and you need diversity and security of supply. It's extremely important. And I think that lesson's been brought home.
Yeah, that I guess reinforces what we had already been learning painfully over the last 2 years about many other supply chains, about nationalization versus brittle global supply chains, whether it's medical equipment and supplies, devices, drugs, whether it's safety equipment, whether it's basically electronic manufacturing, which is necessary for vehicle manufacturing, on and on, just how many things have been crippled because of that easy answer before of just always moving production to the lowest cost jurisdictions, regardless of the vulnerability that leaves you to. Now, you mentioned in passing quite a bit there about uranium. You just came off the first ever Rural Investment Media bootcamp, which was an investing bootcamp about the topic of uranium investing. Could you give us at least some very high-level key takeaways for those who were not able to attend?
Well, first off, Donegan, thank you so much for your contributions to the conference, and your popularizing the conference. Attendance at the conference exceeded my wildest expectations, and as you know, I'm an optimist. It was a very useful boot camp in many senses, and we learned a lot of things. We, as an example, got really good insights to the Chinese view of the uranium market, because we were able to have China General Nuclear, a publicly traded Chinese parastatal, talk about the strategic implications of nuclear energy and the growth of nuclear energy in China. In a word, the future's bright. The Chinese know that as they continue to urbanize their economy, as they continue to move from a lower income country to a higher income country, that they need all forms of power, including nuclear power. The Chinese themselves concede that 500,000 people a year in China die of particulate pollution in the air. And one of the answers to increasingly reliable energy at the same time as energy that doesn't contribute to air pollution certainly is nuclear. That was an important thing we learned. We learned that Kazatomprom, the largest uranium producer in the world, domiciled in Kazakhstan, a location that many people can neither spell nor pronounce, is much less affected by the Russian circumstance than we would otherwise have been led to believe, despite the presence of Russian troops in Kazakhstan to quell domestic political unrest. Kazakhstan reports no hiatus in the shipment of consumables or spares into Kazakhstan, no hiatus in their ability to export finished uranium product on a worldwide basis, and no hiatus at all in their ability to get paid in U.S. dollars. The message from Kazatomprom is that Kazakhstan is Kazakhstan. It's not Russia, which I think was useful. But I think the most important message that we got in the uranium market came from Cameco, the largest North American producer. The Cameco spokesman was, and I've known him for a very long time, he was giddy about the state of the uranium market. He was giddy about the fact that the perception of the spot market had changed to the extent that utilities that for the last 6 or 7 years have been perfectly comfortable to be out of the long-term market, relying on the spot market, are suddenly scrambling for supply. That's important, because if the various producers can lock in supply contracts at $60 or $70 a pound, the sustainability and visibility of their cash flows will allow investors to price them properly. What Cameco has said is that they won't restart their mothballed operations, which are quite substantial, until they have enough volume contracted from those deposits that they can earn a reasonable return on capital employed for their shareholders over a reasonable period of time. And the body language of the Cameco spokesman around the questions about security of revenue was, I think, probably for me, the single most important part of the conference. Don't make any mistakes. The uranium stocks based on the current price of uranium are not cheap. Ironically, the biggest and the finest companies are cheaper relative to the risk involved in owning them than the smallest ones are. The uranium equities market has moved as much on narrative as on arithmetic. But the arithmetic is very, very, very good. If we were to have had this discussion 8 months ago, Donegan, I would have pointed out to you that although $40 a pound for yellow cake was up off its bottom substantially, that the industry still didn't earn its cost of capital. At $60 a pound, while the global industry is not profitable, it earns its cost of capital. It's a viable industry. And it appears to me very likely in the near term, because of the absence of supply from Russia, that the price moves up from 60 to some number like 70. It's also very clear to me that the incentive price for uranium, which is to say the price for uranium that is required to bring new production online, is much higher than I would have anticipated 2 years ago. Inflation in the supply chain means that once you've succeeded in permitting a new uranium mine, no easy job, financing it and building it, paying increased charges for steel, for labor, for tax, for permitting, for cement, for consumables is all higher. It suggests to me that an incentive price for uranium is, rather than the $60 number I would have quoted you 2 years ago, more like $75. And a $75 spot quote probably indicates a very, very firm contract market and lends certainty to the net present value of cash flows among those producers or developers that can point to very good projects. And I think that simple point was really, really, really well made in the conference. You may recall that we began the conference with an overview of the uranium market from WMC, the consultants to Sprott, who are our uranium traders and our strategic advisors in the uranium space. If I might brag, I would suggest that that overview was worth the price of the conference all by itself. But the easiest conclusion that one could draw from there is that at current, uranium production can't accommodate uranium demand. That the slack in the spot market, which occurred as a consequence of some years of overproduction following Fukushima, has been largely consumed by the Sprott Physical Uranium Trust. So the prices have to go up to maintain current consumption. But consumption is rising around the world. And importantly, one of the reasons why consumption is rising is because for the first time in my career, uranium is a politically correct fuel. I never thought that even in my afterlife, I would see a circumstance where uranium was a politically correct fuel. But in the context of the Kyoto Protocols in particular, all of a sudden, people around the world are seeing that energy poverty is a real problem, that the world needs more electricity, and the world needs electricity that doesn't generate carbon, that doesn't generate soot, that doesn't generate sulfur, and that fuels uranium. I think the thing that the conference did really well is it solidified the obvious to people who, unlike myself, hadn't spent 35 years learning the obvious.
Well, I appreciate that update on the recent uranium bootcamp. And now you've got another bootcamp, at least this year, planned, and that's one that I think might attract a larger universe of attendees because it's on the topic of silver that seems to be on a lot of people's mind these days. Do you have a rough timeline or a rough idea of scope on that one?
Yeah, it'll come this fall, October or November. It'll be Silver Investors Bootcamp. We believe that the two executive sponsors will be my former employer, Sprott, a brand name for all things silver, and probably the Silver Institute. We hope to do a very similar format, which is to say an 8-hour-long, exhaustive bootcamp live, which is available for 6 months so that people can consume it over time. In bite-sized bits after they've consumed it live. I hope I haven't nailed this person down. We have a special guest speaker who will be known to virtually every silver speculator on the planet. People can guess his name, but I'm not willing to confirm it yet. We have a tentative confirmation from Randy Smallwood, who, of course, built Silver Wheaton into Wheaton Precious, one of the most important financiers in the silver market. We will have exhibitors who are chosen and curated. Any exhibitor at a rural investment media function is an exhibitor that is held in accounts managed by me or in my own account. That doesn't mean, unfortunately, that all the stocks go up. But what it does mean is that they have been carefully vetted carefully enough that I have invested both my time and my fortune and my reputation on them. As always, this conference will come with an absolute positive money-back guarantee. If you think for any reason that you didn't get your money's worth, email me. Say, I didn't get my money's worth, and I'll give you your $99 back. So we're working very hard on this conference right now. We didn't take a breath after the last one. And we believe that we will put out the most valuable 8 hours that any silver speculator or silver investor will spend this year. By the way, you'll be happy to hear about this. We're going to have a special session on physical surrogates and stacking, because we realize that the equity investor, the equity speculator, is just one part of the silver market. And partly through your own efforts and partly, through the efforts of our friends over at Wall Street Silver, we've come into contact with a fairly large audience who is more physically oriented than equity oriented. And given that the market wants us to talk about that, and we work for the market, we will do a physical and stacking session in our Silver Investors Bootcamp.
One more question on this theme before we get into viewers' questions that were submitted ahead of your arrival here, and that is the big sort of flagship natural resource investing conference. Typically, it had been called the Sprott Natural Resource Symposium in the past. This year, what's it going to be called? When is it going to be held? Where is it going to be?
I think I'm embarrassed to say I don't know what Albert has decided to call it. I'm sure my name is there somewhere. I don't know if it's Rick Rule's Resource Investing Symposium or Rule Investing Symposium. Because of the COVID complications and international borders, we won't be able to hold the conference in Vancouver, BC this year. I don't want to be beholden to the Vancouver government, the BC government, the Canadian government, the US government. I don't want to do that. So we're going to hold the conference in Boca Raton, Florida, a very, very, very high-end resort, which is just done being refurbished. Normal room rates are about $1,000 a night. We're going to be able to turn it out to our exhibitors at $290 a night. It's going to be a very, very, very high-end conference. We're going to have the same type of extraordinary keynote speakers that we have always had at our conferences. Once again, the exhibitors will all be vetted. There won't be an exhibitor there that isn't owned in accounts managed by me or in my own accounts. And by the way, I invest myself in accounts managed by me. I'm really, really, really excited about it. It's going to be at a wonderful waterfront resort, as I say. I'm extremely excited about doing it. I should tell people that can't attend, particularly your international audience, Donegan, that there will be the option to receive the whole conference recorded as a video product. We are not going to be able to make the video product live streamed. So the video product will be available to people 2 weeks after the main conference. Now, as with the Uranium Bootcamp, the content, while not timeless, will not be stale 2 weeks after the conference. But for those people who can't spend 4 days live with us in Boca Raton, but want access to the material, there will be an online video option available. And people who attend live, which I think is the preferable way to do this, will receive the video product for free. Absolutely for free. Now, I need to say, if it's at all possible, attending the live conference is a better experience. I remember in Vancouver 5 or 6 years ago, following Robert Friedland around the exhibit hall at a respectful distance. And the idea that I could see what booths Robert Friedland thought were worth talking to, and watching his body language, asking the booth attendants questions, whether or not he was happy or pleased with the answer, that would have been worth the price of admission. Of course, I had no price of admission because I put on the conference. But what I'm trying to say is the ability to interact with other attendees, the ability to interact physically and personally over a glass of beer with the speakers and with other attendees, the ability to attend informally the boat cruises that we always put on as a function of those conferences is something that's invaluable if you can afford 4 days out of your life to do it physically.
Well, we're looking forward to getting more details on that when you have them. And folks, as soon as we receive it, we'll put a link in the description of this video, even retroactively, and in a future return visit with Rick, and be able to give you a way of signing up and getting in line for that experience as well. Now, if we could turn to some viewers' questions. The first one piggybacks off what we were talking about, jurisdictional risk before, but it broadens out to what you've talked about in the past about government and systemic risk in general. Terry Butner says, Rick, you've talked favorably about keeping a large cash position as, quote, dry powder during this period of time. I'm afraid to keep cash in the bank for fear of bail-ins, or I guess as we've seen in Canada, confiscation, whatever, lockdowns. Is cash sitting in a brokerage account any safer? Is keeping cash in something like PSLV a good option? Please talk about how to safely hold cash during this volatile period.
Let's take that question in reverse order. Things like PSLV or physical precious metals, I personally consider to be cash, albeit volatile cash. And if you consider, as an example, PSLV or silver to be cash, you have to be willing to sell it, even at a small loss, during periods of time where you need the cash for higher and better purposes. So for me, I regard physical precious metals or physical precious metal surrogates as good but volatile cash. Perhaps you should call them liquidity. For other people, the volatility in U.S. dollar quotes for silver obviates many people's psychological ability to use them as cash. In terms of cash in a brokerage account, that really depends on the broker. When I ran a brokerage firm, Sprott Global Resource Investments, I had 16 choices in terms of clearing firms, which is to say 16 choices among firms that would hold my clients' accounts and assets. I chose the clearing firm that I chose, RBC, a subsidiary of the Royal Bank of Canada, because it had the only balance sheet among the 16 clearing firms that I understood. I liked their speculative derivatives position, which was 0. I thought that was a really good number. I liked the fact that they weren't time spread lenders, which is to say funding long-term liabilities with short-term borrowing. So cash in brokerage accounts really is a function of understanding your broker's balance sheet and income statement well. Similarly, some banks are better than other banks. Banks is an example like Farmers and Merchants Bank of Long Beach, where equity is 18 or 19% of total assets, which is to say old-fashioned banks, banks that have money in them, over and above the U.S. government guarantee is a good thing. I should tell your listeners that I'm conflicted in this. I am, despite the fact that I'm 69 years of age and retiring, backing Frank Trotter and the old group from Everbank in starting a brand new bank. One that will be a suitable place to store my own rather large cash deposit balances. I'm not comparing myself with Buffett or anything like that, but relative to the deposit needs that I had 20 years ago, my deposit needs are large now. And I have been involved in creating a financial institution that will, I hope when we get our charter, be in the top decile of payers of deposit interest nationwide, while simultaneously being an extraordinarily safe bank. A bank that doesn't take time spread risk, a bank that isn't a spread lender, a bank that doesn't speculate as a counterparty in derivatives trades, rather an old-fashioned bank that lends on secure assets and treats its depositors well. So any of your listeners who are interested in that, at the end of the show will get my contact. They can simply say bank, because I feel the questioner's concern about the efficacy of deposits in financial institutions that are run for the manager's quarterly cash bonus rather than for the security of my capital.
Yeah, that was actually another theme that came out in the questions that were submitted ahead of you, is to learn more about the bank. Midwest Maverick Photography says, talk more about the bank that he's starting, when and where, just more details would be great. So make sure we hit that at the end so people know how they can get more information. So you'll love this one. Pathetic Prepper asks, is there a secure way of making money on the precious metals I already hold and don't really want to leave my possession, now or in SHTF scenarios that you can think of? Paper loans, PM purchase contracts, etc. If there's an answer, I know you will have it. Rule the day.
Very large precious metals holders can lease their precious metals out to other people. This is usually material that the borrower will use for short position. And so you need to be very careful about your credit decisions. I have from time to time leased out some or all of my precious metals positions where I was comfortable with the balance sheet of the borrower. The only way that I know of to derive value from your existing precious metals holdings is by lending it, which involves a credit decision. One of the important features of my new bank will be that you will be able to borrow against your position. If you have precious metals holdings at, say, Brinks or Loomis, at a large, well-recognized vault, in segregated storage, we would consider that good collateral. So to the extent that you had cash needs, you were, if you will, gold or silver rich but cash poor, and needed to address that, we will certainly loan you money against your gold and silver holdings. Understand, if you don't pay us back, it'll have dire consequences for your, at least for part of your possession of your gold and silver. So to the extent that you have liquidity needs, that's something that I'll be prepared to address. To the extent that you have income needs, you are going to need to be able to make some credit decisions around the borrower of your precious metals. I've done this from time to time, but I would consider myself to be a fairly applied and expert lender, and I'm nervous about folks that don't understand the ropes trying to do this at home.
There's a key word in there that I think I didn't catch until I reread it while you were speaking, and that might affect the logistics of some of the options that you've identified there. The question says, PMs I already own and don't want to leave my possession. Some of those logistical scenarios require that to be vaulted in some place that the borrower or the lessor or whatever.
Yeah, certainly I don't consider precious metals that are, let's say, in the possession of a midnight gardener, to be good collateral. In order to either lend the metal out to a third party or to borrow against the metal, that metal needs to be in the hands of a third party custodian.
Essentially, like on escrow, if in traditional thought, it's in a known and neutral place where it's arm's reach to either party.
That's correct. And I should say that metal that isn't in segregated storage, that is in lesser forms of storage, I'm not willing to lend against that. What that means is that, in fact, I'm lending to the bullion dealer rather than to the individual. And if something goes wrong, I become an unsecured creditor of the bullion dealer. Metal that's in segregated storage, where the vault, which is to say Brinks or Loomis, signs an authorization to me lockboxing the metal, meaning that it stays in the possession of the borrower, but the borrower has to pay me back if he or she sells their metal, or I can sell the metal if they fail to pay interest or don't meet a margin call. That's good collateral, and my bank will only lend against good collateral.
Back on the theme we were talking about earlier about the natural resource investing and so on, this question relates to a phenomenon that may or may not be happening. We'd like your opinion on that, because there are several analysts who are claiming that we're starting to see the beginning of a breakout of the gold mining index or mining shares in general against the metals themselves. Ruby Murray says, would you still consider gold miners to be a good deal?
I still think gold miners, a well-chosen portfolio of good gold miners, to be cheap relative to the gold price. The valuation metric that I like to use is net present value versus enterprise value. Net present value being defined by me as the net present value of future cash flows from developed or developable reserves and resources on an individual company's balance sheet relative to their enterprise value, which is market capitalization plus debt minus cash. By this metric, there are probably 15 or so high-quality gold stocks that are the cheapest that they've been in my career. I can't talk about the technical aspects of the market, which is to say, the bullish chart patterns or anything like that about the equities relative to the metal itself. I can just tell you that from a fundamental basis, the industry is cheap at today's gold price, and I believe the gold price is going higher. Might not go higher in the next 6 months, I don't know. But I think in the next 2 years, 3 years, 5 years, the gold price goes higher. And I think the consequence of that is that the precious metal stocks, the gold stocks, don't merely go higher, but I think select ones go materially higher.
Speaking of metals potentially going higher in the next several years, you've talked to us about reasons that would drive that and reasons you think that those major trends are still in place. For the last, at least 2 years we've been talking about that. In the face of those realities that you've so clearly articulated, people continue to be stunned at the reluctance of, for example, silver to go even above half of its previous all-time nominal high from 1980, et cetera. Can you talk to us about in this environment, if you think that there's still no reason that paralysis of the metals to really reflect the underlying value proposition and respond to those major trends that you've described, how long you think that can continue?
Dunnigan, let's first start by testing your viewers' faith and talk about two things that could cause the precious metals prices to go down as opposed to up. I think you need to look at both sides of the equation. The first challenge is that if the real interest rate in the United States goes less negative, that is to say, if the Fed actually is able to increase the interest rate market in the United States, a circumstance right now where the U.S. 10-year Treasury is yielding 2 in a currency that's depreciating by 6.5% a year is a no-brainer for gold. But if the interest rate were to go up, that is to say, if the 10-year Treasury or CDs or other savings products began to offer a better relative value, that would be harmful to gold. But a second thing that could happen to precious metals in the nearer term that people need to take into account is the fact that maybe the only asset that the Russians have that they can turn into cash right now is gold. Gold is fungible. Gold could be sold by the Russians to, as an example, people in Dubai and be rebranded as Dubai Gold. Now, maybe the Russians would have to take a discount. And I'm certain that the Russians don't want to sell their gold, but I think the Russians might be putting themselves in a circumstance where what they want is somewhat less relevant than what they can have. And I think I think gold holders need to be considerate in the next 6 months about the possibility that the Russians have cash needs in terms of consumables and imports in their society that they can't fund through normal commodity sales, which would settle in US dollars. The most obvious alternative, particularly for imports from China and India, would be gold. And that might put pressure on the gold price. And I think that people who get their sense of value around gold from the price quotes day by day and would be overly concerned about a fall in the gold price from, say, 1,950 to 1,750 need to consider the fact that that's a possibility given Russia's cash needs in the next 6 months. If we look out further, I think both the interest rate challenge and the Russian challenge are easy to overlook. Easy because I think that on a global basis, the economy of the world, but in particular the U.S. economy, can't stomach higher real interest rates for any length of time. We've talked about this before, Donegan, but let's do the arithmetic for people who haven't heard about us talk about that. Traditionally, the U.S. 10-year Treasury, the world's benchmark security, has offered a positive real yield with, depending on which government agency you listen to, the depreciation of the value of the U.S. dollar being between 6.5% and 7.5%, and the U.S. 10-year Treasury yielding 2%. The real yield on the U.S. 10-year Treasury is a function of taking 2 and subtracting 6.5, a truly ugly number. If we were to revert to mean in terms of pricing of the U.S. 10-year Treasury, then the interest rate would have to rise to 6.5 or 7. Can you imagine the impact of the federal, state, and local budgets of a tripling or quadrupling of their interest charge? Can you imagine the impact on consumers if their credit card interest rate doubled? Can you imagine, too, if the 30-year fixed mortgage rate returned to mean? Because the 30-year fixed mortgage rate has traditionally traded at a premium to the 10-year Treasury rate. If the 10-year Treasury rent went to 7, that would suggest that the 30-year fixed mortgage would have to trade at 8. Imagine what that would do to housing affordability. The point of this soliloquy isn't all arithmetic. It's to say that the probability that the policymakers can make substantial interest rate hikes stick is, in my opinion, nil. There could be a near-term impact on gold if the nominal interest rates go higher. But I don't believe that the policymakers will be able to afford an honest economy, an honest interest rate environment for the next 5 years. And the consequence of that is that from my point of view, there is a strong probability of higher gold prices. One more point. I'm sorry for this long-winded answer. When people ask me why this hasn't been reflected to the market, I ask them to reflect on history. Perhaps because I'm older than most of your viewers, that's easier for me because I lived through history. But I remember, although I was only in high school, in 1967, 1968, the writing was on the wall for higher inflation. We had the war in Vietnam, which of course we lost, and the war on poverty, which we lost too. And we had a circumstance in the 1960s where we were living beyond our means. And we began to inflate away the difference between our obligations and the net present value of our servicing capabilities through inflation. But the consumer didn't pay attention. The consumer had lived through the 1950s and most of the 1960s, which were very benign economic times. And the consequence of that is that the academic subject of inflation didn't attract any action until the consumer had lived through 3 or 4 years of inflation, until, despite the fact that he or she were getting pay raises, their standard of living was declining as a consequence of the deterioration of the purchasing power of the dollar. And I see the exact same thing happening now. Voters and consumers have lived through the 40 most benign economic years in the history of mankind between 1982 and 2022. And the consequence of that is that confidence in the economy, confidence in the system is extraordinarily high. People look at the price of gas at the pump and they say, oh, well, that's Russia. They look at the price of bread. Perhaps they say, oh, that's Russia. Perhaps they don't know who to blame. But after 40 years of benign economic circumstance, they think that 6.5% deterioration in the value of their savings is an interesting academic anomaly. It's not. It's a threat to your listeners' well-being. And as that threat manifests itself over 2 or 3 years, the confidence born of 40 years of benign economic climate will be swept away, much like it was swept away in the later part of the decade of the 60s and the early part of the decade of the 70s. I would ask people, too, to consider past precious metals bull markets and the performance of these bull markets. Although from trough to peak, these markets were extraordinary, $35 to $850, in the 1970 to 1982 bull market, $250 to $1,900 in the 2000 to 2012 bull market. In both markets, there were periods of volatility where the market declined by 25 or 30%. And certainly in the case of the 1970s bull market, there was a hiatus in the middle of the market that saw the gold quote decline by 50% without derailing the bull market. The malaise that we have seen in the gold bullion market and certainly the gold equities markets in the 16 months, probably ending 2 months ago, while it tested shareholders' patience and metals holders' patience, is certainly consistent with the occurrence of similar periods of gold weakness in prior bull markets. And your listeners need to familiarize themselves with that history in order to understand the circumstance that confronts them today, and in order to chart their own response to the markets that they see themselves in.
Thank you for that reminder of perspective that helps people keep their feet on the ground, keep their heads upright. And before we let you go, could you remind us if you're still willing to rank people's portfolios and what a typical turnaround time might be that they should expect in that?
Not willing, but eager. I am, however, about 500 rankings behind as we speak. So probably allow 2 weeks for a response. And the offer goes like this. Any Dunnigan Kaiser listener who has enjoyed this discussion and wants a more focused look at their own natural resource holdings may visit a website, ruralinvestmentmedia.com. At that website, enter your natural resource stocks. Please, no crypto. Please, no tech stocks. Please, no pot or narcotic stocks. Just natural resource stocks. And I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues where I think that my comments might have value. In addition, if you care about my bank, in the question line or the comment line, write bank. If you are an accredited investor and are interested in participating in private placements, I can now give you notice of private placements that I'm investing in without violating any SEC rules because I don't get any compensation. I'm not a broker anymore. It's notification. So if you're an accredited investor and you care about natural resource equity private placements, write placements in the comment line. If you would like the charts that I referred to, which are good visual representations of precious metals or commodities, bull and bear markets, write charts in the question and comments. So we've done placements, we've done bank, we've done charts. If you care about the BOCA conference, write BOCA, and we'll send you information about that. But most importantly, if you care about my opinion and my staff and colleagues' opinions on your natural resource holdings, go to ruralinvestmentmedia.com and list them. And as Dunnigan suggests, be patient. We're way, way, way behind.
Well, Rick Rule, as always, on behalf of all of our viewers, just grateful for your presence here with us. We get a level of, seasoned awareness that's rare, and we value it highly. Thank you for joining us here with your wit and wisdom on Liberty and Finance.
Always a pleasure, Dunnigan. Thank you for the opportunity.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold, For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.